The pace of hiring in May reached its lowest level since March of 2023, according to new data out from ADP. Private employers added just 37,000 jobs during the month, below economists' expectations of 114,000. Here to react to the report, we've got Nela Richardson, who is the ADP chief economist. Great to speak with you once again, Nela. Just take us into your reaction. What took place within this most recent month, and how much of this is tied back to tepidness in hiring stemming from some of the tariff uncertainty right now?
Nice to see you again, Brad. You know, we saw some hiring momentum in the early part of 2025, and that momentum is starting to slow. So when I look at this particular report and what's driving the numbers, the first place to stop is the goods sector. The goods sector overall was weak. Manufacturing that had seen a burst of hiring in February and March shed jobs in May, and that's consistent with the manufacturer surveys that we've seen. They've been downbeat and pointing to contraction after showing some signs of earlier optimism. I'll also point to the construction numbers that are lower than we're used to seeing, and so that is a place of weakness. And then when I turn over to the services side, and we got the new data from ISM on the services index showing a bit of a downbeat outlook for service providers even. You see that for professional business services, those B2B businesses, they lost jobs as well. Within all of this, there was some places of strength, and one to highlight is leisure and hospitality. That's a consumer-focused sector. So if the consumers are doing well and they're spending on entertainment, that's a good sign. And I know there's a lot of data here, Brad, but one other important point is that the smallest businesses lost the most jobs. So when you talk about uncertainty and the fog that's kind of on the outlook for now, it's really small businesses that are having the most trouble navigating it in terms of their hiring.
Would love to get your read through on some of the the worker pay, and some of the move that we saw there, because as we're taking a look at the median change in annual pay, it's still paid more to be a job changer than a job stayer. Job stayers seeing a rise of 4.5% versus job changers seeing 7%.
Exactly. Those are robust pay levels. We'll take those all day long. Even as workers, we'll take those all day long to get a bump in pay that is typical of 7% from just changing jobs. Historically is quite robust. And so that tells you two things. One, even though the hiring momentum is slowing, it's not necessarily slowing because of lack of demand. It's slowing maybe because of this hesitancy. And the other thing it tells you is that this is still a relatively tight labor market. This is still a labor market where the workers who are most sensitive to local labor market conditions and real-time conditions, those job switchers, are still seeing outsized pay gains. And so overall, this is a soft spot, 2 months of a soft spot, but in the context of a broader, more resilient labor market.
You know, you raised an interesting point within the small business landscape, and I was just pulling up the NFIB Small Business Optimism Index, which had actually declined during the month of April. So how much of that do you expect to continue to be perhaps a headwind that small businesses are enduring in this near-term period of time, as it might correlate directly through to some of the job openings, the hirings, and as well some of the layoffs that might take place?
Yes, there are several reasons to double click on the small business numbers, including what you noted, which is a slowdown in optimism. It's edging downward. But also, if you think about it, if you look at the quarterly census of employment and wages, and I realize not many people do, but it's almost a near census of every employee in the United States, what you'll see is that about 73% of employment comes from firms with under 250 employees. So small firms are the engine of growth of the labor market. And so to see weakness there is troubling if you're thinking about the outlook and employment in general. And small firms don't have the same options as larger firms. For example, they don't have access in the same way to the capital markets. They're dependent on bank loans. They're not able to navigate in terms of where they're sourcing supply as easily in the short term. They are more vulnerable to input costs. They have thinner margins. And so small firms are really the place to watch if you want to know what the overall economy will be doing in the next few months.
And so if you are the Fed, ingesting and looking through all of this data that's come out over the course of this week, knowing that we're also going to have the monthly jobs report at the end of the week, you had jolts that had a surprise to the upside in openings during the month of April. And then additionally, here you had a far lower than expected print in the private sector in terms of 37,000 jobs added versus 100,000 plus jobs that were expected to be added. What do you think the Fed's read through of all this might be?
I think that for a monetary policymaker, you're going to zero in on the wage and pay data in both the ADP data set and the BLS data set, because wages are the bridge between the labor market and inflation. So if you want to know what the inflation outlook is going to be, one key input, it's not the only one, is pay. Also, it's a good indicator on the overall health of the labor market as jobs data ebbs and flows throughout the year. So when I see those pay numbers of 7% for job changers, 4.5% for job stayers, what I see is a labor market that is still resilient, but not triggering inflation. That gives the Fed the latitude to really kind of continue to decipher their own inflation outlook, because the labor market isn't collapsing and worker pay growth is still growing, but not enough to trigger inflation.
Nela, appreciate the time as always. Thank you so much for taking the time.
Thanks for having me, Brad. Take care.